Are you driving for work? Because if you are, you could be leaving hundreds, maybe even thousands of pounds on the table. Today, we're going to break down exactly how to claim your business mileage correctly, and we're doing it with an expert guide from the specialists over at My Tax Accountant.
I mean, let's just ask the big question right away. Are you paying too much tax just for driving your car? Because honestly, every single business mile you don't claim is a missed opportunity. It's basically you handing over extra cash to the taxman, and we're here to make sure that stops right now.
Now, for a topic this important, you really need information you can trust. That's why everything we're covering today comes straight from the team at My Tax Accountant. These are the folks who help people navigate these exact rules day in and day out.
Okay, let's map out our journey. First, we'll get into the nitty-gritty of what actually counts as a business trip. Then we'll talk money, the official 2025/26 rates. After that, we'll cover how you actually get your hands on that cash, why a mileage log is your best friend, and we'll finish up with some pro tips to get the most out of your claim and how to get help if you need it. All right, first things first. We have to get the fundamentals right. What is the difference between a business trip and private travel in the eyes of HMRC? I'm telling you, getting this wrong is probably the single biggest mistake people make.
So, the golden rule from HMRC comes down to two little words: wholly and exclusively. This means your journey has to be entirely for business. There's no gray area here. It's a really strict definition, and it's the foundation for every single claim you can make. And here you can see that split really clearly. Business journeys, that's stuff like visiting clients, driving between different offices, or heading to a temporary workplace. On the other hand, private journeys, the ones you can't claim for, include your daily commute, popping to the shops, or any travel to a permanent workplace. And I have to stress this, your commute, no matter how long it is never claimable.
Let's make this real. Imagine you're a freelance graphic designer working from home in London. You hop in the car to meet a client in Shoreditch for a project kickoff. Well, that's a perfect textbook example of claimable business mileage. It's a trip for a specific business purpose.
Now, I just mentioned a temporary workplace, and this is a key phrase that really trips people up. So what on earth makes a workplace temporary according to HMRC's rulebook?
Okay, so a workplace is only considered temporary if it meets two really important conditions. First, you have to expect to be working there for less than 24 months. And second, you've got to spend less than 40% of your total working time there. If you fail either one of those tests, HMRC will probably see it as a permanent workplace, and your travel won't be claimable. Let's really hammer down on that time limit. This 24-month rule is an absolute cliff edge. And here's the kicker. It's all about what you expect from the very beginning. So if you're sent to a client's office for a project that you know is going to last 28 months, that is a permanent workplace from day one. Your travel isn't claimable, even if the project gets canceled after just a year.
So, you've figured out your journey is definitely for business. Now for the fun part. What are the numbers? How much can you actually get back for each mile you drive in the 2025 to 2026 tax year?
Here they are, the official HMRC rates for 2025-26. They're called Approved Mileage Allowance Payments, or AMAPs. For cars and vans, it's a pretty generous 45 pence per mile, but only for the first 10,000 business miles you drive in a tax year. For motorcycles, it's a flat 24p. And for all you cyclists, it's 20p per mile with no limit.
Now you really need to pay attention to the rate for cars and vans. See that? After you hit 10,000 business miles, the rate just plummets from 45p all the way down to 25p. That huge drop makes tracking your annual mileage so important if you want to predict your claims accurately and not get a nasty surprise.
And here's a brilliant pro tip that so many people just don't know about. If you give a lift to a colleague on that same business trip, you can claim an extra 5 pence per mile per passenger. So think about it. A 100-mile trip with a colleague in the car, that's an extra $5 in your pocket. It really does add up.
Okay, so knowing the rates is one thing, but how you actually get that money back depends completely on whether you're an employee or you're self-employed. The process is totally different.
So if you're an employee and your company pays you less than that official 45p rate, you can claim tax relief on the difference directly from HMRC. It's called mileage allowance relief. But if you're self-employed, it's much more straightforward. You just deduct the total value of your mileage as a business expense on your self-assessment tax return.
Let's walk through a quick example for an employee. Say your boss pays you 30p a mile. The official rate is 45p, so there's a shortfall of 15p. You just multiply that 15p by all your business miles for the whole year. That final number is what you can claim tax relief on, either using a P87 form or through your self-assessment.
Now, if you're self-employed, you've got a choice to make. Method 1 is the simple way. Just use the flat 45p and 25p rates. Method 2 is a bit more work. You have to add up all your actual car costs, fuel, insurance, repairs, the whole shebang, and then figure out the business use percentage. But, and this is crucial, you have to pick one method and stick with it for the whole tax year. No switching halfway through.
Okay, stay with me here because this next point is absolutely 100% crucial. It's non-negotiable. We have to talk about your mileage log. This isn't just a good habit, you guys. It is the single most important piece of paper or data for your claim. Without it, your claim is basically worthless.
And let's be crystal clear about this. HMRC will flat out reject any vague or estimated logs. A little note in your diary that says something like, about 300 miles for work this month. That's totally useless, and it'll get your claim thrown out immediately if you're ever investigated.
For every single trip, your log has to include these 4 things: the date, your start and end locations, and yes, they want postcodes, the exact number of miles you drove, and a clear specific reason for the trip. Not just client meeting, but meeting with client X to discuss the Q3 project. Be specific. And this is a perfect log entry. See how specific it is? You've got the date, the full postcodes, the exact mileage, and a purpose that leaves zero room for doubt. This is the standard you should be aiming for. This is what makes your claim completely audit-proof.
Look, keeping a manual log in a notebook is a massive pain, and it's so easy to forget. So here's another pro tip. Just use a GPS mileage tracking app on your phone. Tools like MileIQ or TripLog automatically log your drives. All you have to do is swipe left or right to classify them. It takes all the guesswork and human error out of it. Okay, you've got the basics down. Now let's look at how you can squeeze every penny you're owed out of your claim, and just as importantly, how to stay out of trouble with the tax man.
Here's a powerful little fact that might just make your day. If you're an employee and you're just now realizing you haven't been claiming the mileage relief you were owed, guess what? You can go back and claim it for the past 4 tax years. For some people, that could be a very, very nice payday.
Now let's look at where most people go wrong. HMRC has a list of red flags they look for. Things like always rounding your mileage up to the nearest 10, not having that detailed log we just talked about, trying to sneak in personal trips, or having weird mileage patterns that just don't make any sense for your line of work. You want to avoid these at all costs.
Because trust me, the consequences can be serious. If it's a genuine, honest mistake, they'll probably just ask you to fix it. But if they think you've been careless or negligent, the penalty can be up to 30% of the tax you owe. And if it's deliberate fraud, that penalty can jump to 100%, on top of having to pay all the tax back. It's just not worth the risk.
Okay, we've covered the rules, the rates, and the risks. Before we wrap up, let's quickly recap the absolute essentials to make sure you're feeling confident about your claims.
So what's the bottom line? It really comes down to this. First, know the difference between a business trip and your commute. Second, always use the correct 2025/26 rates. Third, keep a detailed, accurate log. It is your absolute best defense. And finally, make sure you're using the right claim method for your situation, whether you're employed or self-employed.
So, after all that, how are you feeling? Are you confident you can get this sorted yourself? Or does your situation maybe feel a little more complicated? Maybe you have multiple jobs or vehicles or other things going on.
If you have any doubt at all, honestly, the smartest move you can make is to get personalized advice from a professional who can look at your specific circumstances and give you the right answer.
And for that, you can get in touch with the experts at My Tax Account. Their phone number is 0208-570-8531. The email is info@mytaxaccountant.co.uk. For a really deep dive, you can read their full article on their blog at mytaxaccountant.co.uk. And of course, while you're there, make sure you subscribe to their YouTube channel for more essential tax tips just like this.
And just a final important note, the information we've shared today is for general guidance only, and it shouldn't be relied on exclusively to make financial decisions. Tax rules can be complex, and they really depend on your individual situation. So before making any decisions, you must consult a qualified tax expert, like the fantastic team at My Tax Accountant.